Silicon Valley Bank was founded as a wholly owned subsidiary of Silicon Valley Bankshares on October 17, 1983, by Bill Biggerstaff and Robert Medearis, who came up with the idea over a poker game. Its first office opened in 1983 on North First Street in San Jose. The bank's main strategy was collecting deposits from businesses financed through venture capital. SVB quickly became a key lender to U.S. startups since the 1980s, especially in the technology sector. It helped service companies like Apple, Cisco, Intel, and Oracle. They offered loans and other banking services to these businesses, such as cash management, foreign exchange, and trade finance. In 1984, SVB launched its Pacific Rim and Trade Finance division, which focused on providing banking services to companies doing business in Asia. In 1987, SVB introduced its venture capital group, which provided customized banking solutions to venture capital firms and their portfolio companies. SVB also pioneered some innovative products and services in the 1980s that differentiated it from other banks. For example, it offered a venture debt product that allowed startups to borrow money based on their future revenue potential rather than their current assets or cash flow. It also created a venture leasing product that enabled startups to lease equipment without putting up collateral or diluting their equity. By the end of the decade, SVB had grown to become one of the largest banks in Silicon Valley, with over $1 billion in assets and more than 10 branches across California. It also had a reputation for being customer-focused, flexible and responsive to the needs of its clients. SVB continued to grow and diversify its business in the 1990s, despite facing some challenges such as the real estate burst in 1992 that caused a $2.2 million yearly loss. The bank recovered by focusing on its core strengths in serving technology and life sciences companies. In 1990, SVB opened its first office on the East Coast, near Boston. It also expanded its presence in other regions such as Colorado, Texas, Arizona, and Washington. It also established its first international office in London in 1998. SVB also launched new products and services such as SVB Capital, SVB Securities, SVB Asset Management, and SVB Private Bank. By the end of the decade, SVB had become one of the leading banks for innovation companies, with over $5 billion in assets and more than 20 offices worldwide. SVB faced a difficult period in the early 2000s, as the dotcom bust and the 9/11 attacks triggered a recession and a decline in venture capital activity. The dotcom bubble was a period of excessive speculation and investment in internet-based companies that peaked in March 2000, and collapsed by 2002. Many of these companies went bankrupt or lost most of their value, causing huge losses for investors and lenders. SVB was one of the main lenders to these companies, as it specialized in providing banking services to startups and venture capitalists. SVB had a large exposure to the dotcom sector, with about 60% of its loan portfolio consisting of technology loans at the start of 2000. When the bubble burst, SVB suffered significant losses and write-offs on its loans. Its net income dropped from $113 million in 1999 to $16 million in 2000, and its non-performing assets increased from $38 million to $247 million. SVB also faced regulatory scrutiny and lawsuits from shareholders and borrowers who accused it of fraud, negligence, and breach of fiduciary duty. However, SVB managed to survive the dotcom crash by taking several measures to restore its financial health and reputation. Some of these include raising $300 million in capital from private investors in 2001, cutting costs by reducing staff, closing branches, and selling assets, diversifying its loan portfolio by expanding into other industries such as life sciences, energy, and media, improving its risk management practices by tightening its underwriting standards, increasing its loan reserves and monitoring its clients more closely, strengthening its relationships with its clients, regulators, and stakeholders by enhancing its transparency, communication, and governance. By 2003, SVB had returned to profitability and growth. It reported a net income of $94 million for that year, up from $37 million in 2002. Its non-performing assets decreased to $69 million, down from $172 million in 2002. It also regained its market share and reputation as a leading bank for innovation companies. It acquired Alliant Partners in 2001, SVB Analytics in 2004, and Boston Private Bank and Trust Company in 2006. It also expanded its international presence by opening offices in China, India, and Israel. SVB also continued to support innovation companies across various sectors such as software, hardware, biotechnology, clean tech, and social media. By the end of the decade, SVB had recovered from the downturn and achieved record profits and growth. It had over $20 billion in assets and more than 30 offices worldwide. It had also established itself as a leader in global innovation banking. It had financed some of the most successful startups such as Amazon, eBay, Google, Netflix, Facebook, LinkedIn, Twitter, and Uber. SVB enjoyed a decade of growth and success in the 2010s, as it capitalized on the booming tech industry and innovation economy. It increased its assets from $20 billion to over $200 billion, and its net income from $100 million to over $1 billion. SVB also expanded its global reach and influence by opening offices in Germany, Ireland, Canada, and Australia. It also established strategic partnerships with banks in Brazil, Denmark, France, and Turkey. It served over 50% of U.S. venture-backed companies and 67% of U.S. venture capital firms. SVB also launched new initiatives and programs to support innovation and social impact such as SVB Trek, SVB Women in Technology Leadership, SVB Impact Fund, and SVB Foundation. However, SVB also faced some challenges and risks in the 2010s, such as increased competition from other banks and fintech companies, regulatory scrutiny over its lending practices and exposure to volatile markets, cybersecurity threats, and fraud cases. SVB entered the 2020s as a dominant player in the global innovation banking sector, with over $200 billion in assets and more than 40 offices worldwide. It continued to serve thousands of tech companies, venture capitalists, private equity firms, and entrepreneurs across various industries such as software, hardware, biotechnology, clean tech, and fintech. SVB also faced some challenges and disruptions in the 2020s due to the COVID-19 pandemic, which affected its clients' businesses and cash flows. SVB offered relief programs such as payment deferrals, fee waivers, and loan modifications to help its clients cope with the crisis. However, SVB also made some strategic mistakes and missteps in the 2020s that ultimately led to its downfall. Some of these include overextending its lending portfolio to risky and unprofitable tech companies that defaulted on their loans or went bankrupt, failing to maintain adequate capital and liquidity ratios to meet its obligations and regulatory requirements, engaging in fraudulent activities such as inflating its earnings, hiding its losses, manipulating its stock price, and falsifying its financial statements, losing trust and confidence from its shareholders, depositors, clients, and regulators due to its poor governance, lack of transparency, and ethical breaches. On March 10, 2023, SVB was closed by the Federal Deposit Insurance Corporation after it failed to raise enough capital or find a buyer. It was the second largest bank failure in U.S. history after Washington Mutual. The FDIC sold most of SVB's assets and deposits to Wells Fargo for $15 billion. The rest of SVB's operations were liquidated by a court-appointed receiver.